Everyone knows they're supposed to have a good credit score. It's one of those things that gets drilled into you early. Pay your bills on time, don't max out your cards, check your credit. It's financial common sense at this point. But here's what nobody actually explains. What a bad credit score costs you. Not in abstract terms. Not it'll be harder to get approved. In real dollars. Actual money that leaves your pocket because of a 3-digit number. Most people treat their credit score like a grade, a thing that's good or bad, but doesn't really have a price tag attached to it. It does. And by the end of this video, you're going to know exactly what that price tag looks like. Because once you see the numbers, the way you think about credit changes completely. Before we get into it, I'm not a financial advisor, and this is not financial advice. Everything I share here is for educational purposes only. I'm going to give you a framework for how I think about this topic, but your situation is unique. Take what makes sense, leave what doesn't, and if you're making a major financial decision, always talk to a qualified professional first. All right, let's get into it. Here's what everyone watching this wants. You want to keep more of your money. You want to stop paying more than you have to for the things you're already going to buy. A car, a house, a loan when life throws something at you. You're not trying to game the system. You're just trying to not get penalized for something you didn't fully understand. That's a completely reasonable thing to want. And the good news is, credit is one of the most fixable numbers in your financial life. But you have to understand what it's actually costing you first. Here's the problem. Most people know their score is low, but they have no urgency around fixing it because the damage feels invisible. You don't get a bill that says, credit score penalty $287 this month. It just quietly shows up in your interest rate. And most people sign loan documents without ever doing the math on what that rate difference actually means over time. So let's do it right now. Mortgage first, because this is where the numbers hits hardest. Here's how I think about it. Let's say you're buying a $350,000 home on a 30-year fixed mortgage. If your credit score is 760 or above, which is considered excellent, you might qualify for a rate around 6.5% right now. Now your monthly payment on the principal and interest is roughly $2,213. Now let's say your score is 620. Same loan, same house, same bank. Your rate jumps to around 8%. Your monthly payment is now $2,568. That's $355 more every single month. Over 30 years, that's $127,800 for the same house, just because of a number attached to your name. Now let's talk cars, because most people finance a car before they ever buy a house. Two people walk into a dealership, same car, $35,000. 5-year loan, person one has a 750 credit score, they get 5% interest. Monthly payment around $660. Total paid over 5 years, about $39,600. Person 2 has a 580 score. They get 14% interest. Monthly payment jumps to $814. Total paid, about $48,800. That's $9,200 more for their exact same car. And credit cards, if you carry a balance, which most Americans do, your interest rate is determined largely by your credit score. The difference between a 15% APR and a 24% APR on a $5,000 balance is over $450 in interest alone, every single year, just sitting there. Add it all up. A person with poor credit who buys a home and finances a car over their lifetime can easily pay $150,000 to $200,000 more than someone with excellent credit. Same income, same purchases, just a different score. That's the invisible tax that nobody talks about. Here's what shifts everything. Your credit score is not a permanent verdict. It's a snapshot. And it responds faster than most people think when you start moving the right levers. There are 5 factors that make up your score, but 2 of them account for 65% of it. Payment history is 35%. Credit utilization, meaning how much of your available credit you're using, is 30%. That means if you do 2 things consistently, pay on time and keep your balances below 30% of your limit, you are already working on nearly 2/3 of your score. Here's a move most people don't know about. If you have a credit card with a $5,000 limit and you're carrying a $4,000 balance, you're at 80% utilization. That's crushing your score. But if you call that card and request a credit limit increase to $10,000 and they approve it, without charging anything new, your utilization just dropped to 40% overnight. Score goes up without paying anything down. You just change the ratio. Another one, becoming an authorized user on someone else's card. A parent, a spouse, a family member with good credit adds their credit history to your report. If they've had that card for 10 years with a clean record, that history now shows up on your file. The last one, dispute errors. According to the FTC, 1 in 5 credit reports has an error on it. An account that isn't yours, a late payment that was reported incorrectly, a balance that was paid off but still showing, you can dispute these directly with the credit bureaus for free. If they can't verify the information within 30 days, they have to remove it. Here's the framework to apply to your own situation. Your credit score is not just a grade, it's a price multiplier on every major purchase you make for the rest of your life. The difference between a good score and a poor score on just a house and a car can cost you well over $100,000. And the score is movable. It responds to real actions, payment history, utilization, credit limit increases, authorized user status, error disputes. These are not complicated things. They're just things most people never had explained to them clearly. Start with your report. You can pull all 3 bureaus for free. Look for errors first, then look at your utilization on every card, then set every bill you have to autopay so your payment history runs on autopilot. Do those 3 things and your score will look different in 90 days. Apply what makes sense for your situation, and if you're making a major credit decision, a mortgage, a car loan, anything significant, talk to a qualified professional first. Next video, we're going to tackle the emergency fund, specifically how much you actually need and why the numbers most people throw out is probably wrong for your situation.